If you've been waiting for mortgage rates to drop below 6% before making a move here in Frisco or Prosper, then there's something important that you need to consider. Because believe it or not, the real risk right now may not be rates staying above 6%. It may be what happens if they drop. Now, this is not a rate prediction video by any means. It's more of a decision framework, as it's important to understand what's going on in order for you to make the decision that is best for you. Now, if we haven't met before, my name is Andrew with the Andrew Smith team, eXp Realty here in Frisco and Prosper, and I primarily work with move-up homeowners and relocation clients here in Frisco, Prosper, helping them think through their real estate decisions strategically. And what I've learned over time is that one of the biggest mistakes in real estate is rarely a math mistake. It's more about timing and psychology. Now, over the last several months, I've had multiple conversations that sound almost identical. And there's many buyers that say, rates are coming down, and as soon as they get underneath 6%, I'm going to make a move. And I understand that. Let's face it, there's something psychologically different about a number that starts with 5 instead of a number that starts with 6. When it starts with 5, it feels like progress. It feels like momentum. It feels, safer to a certain extent. But here's the question I need to ask you. Is that a strategic decision, or is it emotional? So with that in mind, let's take a brief look at the math behind this. So, stay with me here. Let's just assume you've got a $500,000 loan. Now, did you know that the difference between today's rate of roughly 6.2% and a rate of 5.99% on a $500,000 loan is roughly $67 a month? That's not nothing, but it's also not a transformative number. It's not going to fundamentally change affordability for someone who's already financially stable looking in that price range. What it does change dramatically, however, is behavior. Because when rates dip below a major psychological threshold, such as that 6% number, demand moves. And that's something that we've already seen. Now, about a month ago, rates briefly dipped under 6%. And you know what happened? Buyer activity jumped. There was more urgency. There was more showings. There was overall a lot more people out inquiring about property. Now, when we look at the local reality here in Frisco and Prosper, there's something to keep in mind, and that's that inventory or supply has not made a meaningful turn for the year as of yet. I'm not saying it won't. We expected it to ramp up last spring, and it never actually did. As a matter of fact, in the recent market report I just did, it showed that inventory was actually still declining, not increasing. So consider this. If demand increases and supply remains constrained, that means competition increases. Negotiating leverage sinks, sellers gain confidence, and pricing pressure begins to build. That's not speculation. That's just how markets function. Now, let me give you a practical example here. Let's say for just a minute, rates got down to 5 3/4. I'm not saying that they will, but let's say rates got down to 5 3/4. A noticeable percentage of buyers who have been waiting to re-enter the market, what are they going to do? They're going to jump back in. Now, if inventory remains relatively flat, our supply does not go up, instead of negotiating calmly on a home, you're now more than likely going to be competing with 1 or 2 additional buyers. Now, don't get me wrong. I'm not saying a frenzy is going to appear. I'm not saying there's going to be a massive bidding war, but there will be more activity. And instead of negotiating $20,000 off the list price or getting more incentives from that seller, you could possibly be paying much closer to full price. Now, if you think about that, if home prices move even 2 or 3% because of that increased competition, that is easily going to offset that $67 a month savings between today's rate and 5.9%. Now again, this doesn't mean that moving today is the right move for everyone, but what it does mean is that the decision is not necessarily as simple as just waiting for a mortgage rate to fall, waiting for that number to change. Right now, we are in what I would call the calm window. We've been seeing it for the last couple of weeks. There's less emotional bidding. There's more negotiation taking place. Buyers with days on market increasing are able to make more thoughtful decisions, and there's more ability to structure deals carefully. It doesn't mean we're in a buyer's market in the traditional sense of the word by any means whatsoever, but it does mean that there is still more leverage for buyers in certain situations. And I've got to be honest, sometimes the best opportunities don't appear when the headlines improve. They appear when there's fewer people paying attention. We're also seeing another subtle shift happening here locally. If you've seen videos I've done before, you may recall that last fall, builders, new home builders, were being very aggressive with financing incentives in order to move standing inventory. They were offering rate buy downs. They were offering quite a lot of money in closing cost assistance, and they were also doing additional design incentives. But over the past several weeks, I've noticed that some of those incentives have quietly started to normalize. Nothing dramatic, but noticeable if you're paying attention. Not every builder, not every situation, but it's something that really matters, because incentives are typically the first lever a builder pulls when demand slows. It's also the first lever they remove when demand starts to stabilize. So if rates dip and demand increases in a meaningful manner, incentives don't usually get better, they disappear. They're almost, and I'm not trying to be alarmist in that by any means, or saying you have to jump in now. It's just the simple way supply and demand works, and it's what I'm seeing currently right here in the local market. So the real risk here may not be higher rates. The risk may be increased competition, reduced negotiating power, upward price pressure. And again, I'm not saying prices are going to run away, but we could see upward price pressure and the emotional urgency that starts returning to the market. Now, strategic buyers don't just ask the question, what's the rate today? They ask is, what's the market or the environment going to look like if this changes? And that second level thinking is what protects your leverage. Now, to be clear, this conversation certainly does not apply to everyone. If you're currently stretching to qualify for a home, if small payment changes are really going to make a dramatic impact on your monthly budget, if the margins are tight, that is a completely different conversation. It's completely different analysis. But if you are a move-up buyer, a homeowner sitting on significant equity, or if you're financially stable and you're thinking long term, or even if you're a relocation buyer and you're trying to evaluate timing, or someone that's considering a higher end purchase, then this becomes a leverage conversation, not just a rate conversation. So when I speak with people, what I do is I use a simple, very simple framework to evaluate timing decisions with my clients. And there's typically 4 things that I look at. Number 1, financial capacity. Are you strong enough financially right now that small shifts in the rates don't dictate what else happens in your life? Number 2, equity position. Are you in a strong equity position either through savings or through the current equity in your home to take meaningful advantage of the current market? Number 3, we look at the competitive environment. We're going to take a look at how much leverage exists today versus what may exist a few months from now. And lastly, number 4, the long-term horizon. Are you planning on holding on to that home long enough that short-term rate fluctuations matter even less? So when you evaluate timing through that lens, the decision becomes far more nuanced than, are rates below 6% yet? So the real question, again, isn't whether those rates dip below 6%. The question is, does that dip create opportunity or does it create competition? Because sometimes the best time to move isn't when conditions feel exciting, it's when things are relatively calm. So if you've been wondering whether now or waiting actually makes more sense to your specific situation, let's run the numbers strategically. Not emotionally, not based on some headlines, but based on your equity, your long-term goals, and your leverage in this specific market. And again, the right decision isn't universal, it's contextual. And context is actually where the strategy lives. So if you'd like to take advantage of that, I invite you to go ahead and book a call with me. You can, in the description below, you're going to find a link to my calendar. Go ahead and schedule a free 30-minute consultation. Be more than happy to go through your specific situation and help you make the decision that is right for you and your family. Thanks so much for watching, and I will see you in the next video.